With benchmark rates high and inflation eating into the dollar, cash in a standard savings account loses purchasing power every single day. Correcting that loss is harder than it sounds. The internet is currently flooded with ads for 4.5% high-yield savings accounts, 5% CDs, and treasury bills. It is a dense maze of percentages that often leads to analysis paralysis. To understand those numbers, look at the macroeconomic context. The Federal Reserve has maintained its benchmark interest rates between 3.5 and 3.75% throughout 2026. Because high-yield savings accounts use variable rates, your earnings are directly tied to those Fed decisions. The moment the Federal Reserve initiates a rate cut, your account's APY will drop almost immediately. Chasing the highest advertised APY often leads to a trap where users ignore the fine print and find their cash tied up in accounts with restrictions that don't match their actual liquidity needs. Choosing where to park your money requires balancing two factors: your exact timeline for when you'll need that cash, and the amount of administrative effort you're willing to put in to maintain the account. This chart maps your options. We plot liquidity, how fast you can get your cash, on the bottom axis, and yield, the growth potential, on the vertical axis. Your traditional savings account sits in the bottom left, high access but near zero growth. High-yield savings accounts sit in the center. They provide a moderate yield while keeping your money liquid and easy to transfer to other accounts. Certificates of deposit, treasury bills, and index funds occupy the upper right. These options offer higher returns, but they severely restrict your ability to withdraw funds on short notice. Optimizing your cash requires matching the specific financial vehicle to your personal time horizon. Your first primary bucket is the Agile Emergency Fund. For money you might need tomorrow, immediate access is the most important feature. This table shows the yield optimizer tier of high-yield savings accounts. Banks like SoFi and Varo advertise aggressive rates between 4 and 5% APY. To actually qualify, you must meet strict requirements, involving routing $1,000 to $5,000 in direct deposits. Meeting those requirements usually means shifting your primary checking account and payroll deposits entirely to another bank. All-in-one ecosystems like Ally or Capital One offer a different path. These accounts provide integrated checking, highly rated mobile apps, and no minimum balance or direct deposit requirements. The trade-off is a lower yield, often around 3%, and the inability to deposit physical cash, since these are online-only institutions. For an emergency fund, the question is whether an extra percent in yield is worth the administrative burden of meeting constant banking requirements. The second bucket is the rate lock, designed for cash you know you'll need in exactly 6 to 12 months. This timeline shows how a 12-month certificate of deposit functions. It guarantees a fixed return of about 4.2% for the entire term, even if market rates drop. This fixed rate insulates your cash from Federal Reserve cuts, keeping earnings constant until the term ends. Treasury bills offer a government-backed version of this same strategy, allowing you to secure a set rate over a fixed window. The risk is the lack of liquidity. Your capital is trapped, and early withdrawals trigger penalty fees that can easily wipe out your earned interest. CDs and T-bills are defensive tools against falling interest rates, provided you are certain you won't need that cash before the maturity date. The final bucket is the inflation hedger, meant for excess cash that you won't need for 5 years or more. Over a long timeline, even a high-yield savings account loses out to the real rising costs of goods and services. For this money, the goal is migrating away from cash and into broad market ETFs, like VTI, or dividend-focused funds, like SCHD. This comparison chart shows $10,000 over a decade. While the savings account shows modest growth, the S&P 500 has historically averaged annual yields between 7 and 10%. Some investors utilize precious metals as a hedge. While these hard assets offer insurance, they lack the compounding interest provided by market funds. The trade-off is short-term volatility. You need a time horizon of at least 5 years to weather market downturns and avoid selling at a loss. Building wealth requires accepting fractional market risk. Keeping long-term capital in safe cash accounts is a losing strategy over the long run. To find your specific solution, start with a single question. When do you need this money? This flowchart maps the choose. Cash needed under 6 months is your emergency fund. Use Ally for easy access, or SoFi for higher yield. For 6 to 12 months, follow the center branch. A Marcus CD secures your rate today. Your specific spending timeline determines which vehicle and risk level is appropriate. Finally, if you won't need the money for 5 years or more, you are in the wealth building phase. Move those funds into broad market index funds or ETFs to outpace inflation and grow your purchasing power. Be cautious of financial advice that focuses solely on a 5% yield without accounting for your personal need for liquidity. The most effective strategy is to ignore the marketing headlines and choose the vehicle that fits your specific time horizon.